Imagine waking up tomorrow. You open your investing app and discover that some of the world's biggest investors, CEOs, and company insiders have quietly sold billions of dollars worth of stock. No headlines, no panic, no breaking news, just gone. Now ask yourself one question. What do they know that the rest of us don't? History has shown that when experienced investors begin reducing risk, it's not always because they expect an immediate crash. Sometimes they're locking in profits. Sometimes they're preparing for uncertainty. And sometimes they're simply following a long-term strategy. But how can ordinary investors tell the difference? Today, we're uncovering why some billionaire investors are quietly selling, what history teaches us, and what lessons every investor should learn before making their next financial decision. Let's begin. Most people imagine billionaires as fearless investors, buying more, taking bigger risks, never worrying about the future. But the reality is very different. Many wealthy investors don't focus on making the highest possible return. They focus on protecting what they already have. Imagine you have $100. Losing $50 would hurt. Now imagine having $50 billion. Even a 5% decline could erase billions on paper. That's why preserving wealth often becomes more important than chasing every opportunity. Many successful investors think differently. When markets become expensive, when uncertainty increases, or when they simply believe prices have risen too far, they often reduce their exposure. Not because they know the future with certainty, but because they understand risk. Here's something most people misunderstand. Selling stock doesn't automatically mean someone expects a crash. There are dozens of reasons why investors sell. Maybe they want to diversify. Maybe they need cash for another investment. Maybe they're paying taxes. Maybe they're funding a new company. Or maybe they simply believe the stock has become fully valued. Professional investors rarely make emotional decisions. Instead of asking, "Can I make another 20%?" they ask, "How much could I lose if I'm wrong?" That simple change in thinking separates professionals from beginners. Cash often gets a bad reputation. People think holding cash means you're missing opportunities. But many legendary investors view cash differently. Cash isn't just money sitting idle, it's flexibility. When markets fall sharply, many investors panic because they have no money left to invest. But those holding cash suddenly have options. History has repeatedly shown that market downturns often create opportunities for patient investors. Having cash during uncertain times allows investors to buy quality assets when prices become more attractive. That doesn't mean markets will always fall. It simply means being prepared matters. Every generation believes, this time is different. But history tells another story. We've seen technology booms, housing booms, .com excitement, crypto surges, AI enthusiasm. Every major innovation creates excitement. Sometimes that excitement is justified. Sometimes prices rise faster than reality. The challenge isn't identifying great technology. It's determining whether expectations have become unrealistic. Smart investors constantly ask, is this price supported by real business performance? Or is excitement driving prices higher than fundamentals? That's one of the hardest questions in investing. Another topic that often grabs headlines is insider selling. When company executives sell shares, people immediately assume something is wrong. But that's not always true. Executives receive much of their compensation in company stock. Over time, they may simply diversify their personal finances. That's completely normal. However, if many executives across different companies begin selling heavily while business conditions weaken, investors naturally pay closer attention. Context matters far more than headlines. One sale means very little. Patterns tell a much bigger story. Here's where many ordinary investors struggle. When markets rise, they become more confident. They buy near record highs. When markets fall, fear takes over. They sell near the bottom. Ironically, professional investors often behave differently. They prepare before panic arrives. They build emergency reserves. They diversify. They avoid emotional decisions. Investing isn't about predicting tomorrow, it's about surviving uncertainty. No one consistently predicts every market move. Even the world's best investors make mistakes. What separates them isn't perfection, it's discipline. So, are billionaires quietly selling because a massive crash is coming? Maybe, maybe not. The truth is, no one knows exactly what tomorrow will bring. Markets are influenced by thousands of factors: economic growth, interest rates, innovation, politics, consumer confidence, global events. Instead of trying to predict every headline, focus on building a strategy that works through both good times and bad. Protect your downside. Stay diversified. Think long-term. And remember, successful investing isn't about reacting to fear. It's about making thoughtful decisions based on evidence rather than emotion. If you found this video helpful, consider subscribing for more videos that break down complex financial topics into simple, easy-to-understand explanations. Thanks for watching, and I'll see you in the next video.